Hi, I'm Steve. I'm going to share my thoughts on how you can achieve a better financial future. Please remember, I don't know anything about your situation, so think for yourself and use what fits. Let's dig into the basics of investing, and we'll start by defining a few terms. You just need to know a few of them. Investing means giving up money now in return for an expectation of more money returned to you at a later date. The success of the investment is measured by the annual rate of return or annual return. If the value of your investment goes up 10% a year, your rate of return is 10%. This could be a stock price going up or a rental house going up in value, same math. Now, just for fun, a quick segue. In the 15th century, a scholar published the first reference to the rule of 72. This math magic gives a very close estimate of how many years it will take to double money by dividing 72 by the rate of return. If the rate of return is 10%, then it takes 7.2 years to double your money. Now, back to investing. There are two basic types of investment: loaning money to a person or institution, and buying a share of a business or an asset. For short-term needs, it usually makes sense to be a lender. For longer-term goals like retirement, you'll probably want to buy part of a business or other productive asset. We'll discuss this more a little later. Let's take the loan first. The interest rate or price will mostly depend on the riskiness of the borrower, i.e. their credit rating, and how long the loan is. Let's look at these loans by type of borrower. First, the federal government. The risk of loss here is near zero, so the shorter the loan, the lower the rate. And today, that rate is almost 0% for a short-term loan and about 2% for a 10-year loan. Alternatively, you could loan to a bank. These are called CDs or certificates of deposit. The bank pays you a fairly low rate and then lends the money to their customers at a higher rate for home mortgages, car loans, etc. Finally, you could loan to public companies. These loans are usually called bonds. The rate varies depending on the borrower's credit score, and the companies invest in their business and attempt to earn more than the cost of that debt. If the company gets into trouble, it pays back borrowers before the owners get anything. And finally, there's always your Uncle Fred. I think that sounds pretty risky. Well, that's it for this session. Thanks for watching, and I'll see you next time.